Balance sheet is best understood by looking at actual company financial statement. I will show you balance sheet of Reliance Industries from March 2021 annual report. In this session, I will explain what are the different line items on assets side of balance sheet, how to analyze each line item using note to balance sheet. I would recommend watching previous video on balance sheet before you delve into actual balance sheet of Reliance Industries. Balance sheet is a financial statement that provides information about company's assets, liabilities, and shareholders' equity. Let's review assets side of balance sheet first. As you notice, it shows all the assets that company owns. Assets are the company resources which help in manufacturing the products or providing services. In short, it helps company in generating revenues. Let's get into the details of each line items on balance sheet. You will notice assets are classified into two distinct categories: noncurrent assets and current assets. Let's review noncurrent assets first. Noncurrent assets are the long-term investments that have a useful life of more than 1 year. These assets cannot be easily converted to cash within a year. It includes things like property, plant, equipment, capital work in progress, goodwill, and so on. I will go over each line item shortly. The next category of assets is current assets. Current assets are the assets that can be converted into cash within a year. It includes product inventories, financial assets like fixed deposits, money due from suppliers, and so on. I hope you noticed column with heading Note. The main purpose of Note to balance sheet is to further clarify breakup of each line item. You can open company annual report and go to corresponding note to understand detailed breakup of each type of assets. It provides more clarity on company assets and very useful for fundamental analysis of stocks. It's time to go into details of each type of assets. Let's start with non-current assets. Balance sheet includes several assets type reported as non-current assets. Let me list down each asset type you will typically notice on balance sheet. Property, plant and equipment. Capital work in progress. Goodwill. Intangible assets. Financial assets. Deferred tax assets. Other non-current assets. Let's get into details of each line item. In annual report, you can always review corresponding note to understand what is included in each assets type. Let's start with property, plant and equipment. These are long-lived assets having life of more than 1 year. It includes several assets like property, plant, equipment, machinery, vehicles, furnitures, and so on. These are also called as fixed assets. The fixed assets have estimated useful life of several years. Please remember, fixed assets are depreciated over its useful life. They are recorded on balance sheet at acquisition price minus depreciation. If you have a question, what does it mean? Let's take an example. Company spends money on buying machines and equipments that have life of several years. Let's assume company, ABC, bought new machine for 10 crore that will have an expected life of 10 years. For first year, the assets of 10 crore will be recorded on balance sheet. However, its value will be depreciated on balance sheet as per this chart over next 10 years. For second year, the value of asset will be depreciated by 1 crore and its value will be 9 crore on balance sheet. Eventually, its value will be 0 after 10 years since it needs to be replaced considering expected life of 10 years. Please remember, if company assets are close to the end of life, company will incur significant expenses in future to replace assets, reducing overall company cash position. Next line item is capital work in progress. As the name suggests, these are assets in progress at the time when balance sheet is prepared. It includes assets in progress like plant, machinery or building under construction. Let's move on to the next line item: goodwill. You won't see goodwill on balance sheet unless one company acquires another company. When an acquisition is done at a price greater than company's net asset value, goodwill magically appears on balance sheet. Goodwill is the difference between cash paid for the acquisition and actual value of the assets. Let's understand this concept with example. Company A acquires Company B for 120 crore. Let's assume Company B has assets of 110 crore and 10 crore of liabilities. The net value of assets is 100 crore. However, Company A paid 120 crore for acquisition. Now let's understand how it impacts balance sheet of Company A. You need to carry over net assets of Company B on balance sheet of Company A. It will be carried over as 100 crore of net assets and remaining will be recorded as goodwill. Let's see how balance sheet of Company A will look like. 110 crore is recorded under assets and 10 crore under liabilities. This means 100 crore of net assets. Additional 20 crore of assets will be created on balance sheet as goodwill. Goodwill shows up on balance sheet because without goodwill balance sheet of Company A will not balance. When you see large goodwill on balance sheet, please remember in reality goodwill means nothing. You should always remove assets related to goodwill during company valuation. The other non-current asset is intangible assets. It includes brand, copyrights, patents, trademarks, and so on. It appears on balance sheet only if they are acquired assets. This means when one company acquire assets of another company. For example, HUL has significant brand value. It will never show up on balance sheet as intangible assets. It will show up only for acquired company. This is important concept in valuation since there are companies that have huge intangible assets that never show up on balance sheet. These intangible assets create competitive advantage and makes it difficult for competitor to sell their products. For example, Bajaj Finance has network advantage. IRCTC is literally monopoly. Such intangible assets will never show up on balance sheet. Let's summarize goodwill and intangible assets. Goodwill is the premium paid over fair value of assets during acquisition of company. Hence, it cannot be sold and purchased independently. Intangible assets like brand, copyrights, patents, trademarks, can be sold and purchased independently. The next line item is financial assets. Just like individual, company invest surplus money with the expectations to seek higher return in future. It includes investment in bond, debenture, government securities, investment in mutual funds, equity and so on. It also includes interest on loan given to employees and suppliers, fixed deposits and other investments. Next line item is deferred tax assets. A deferred tax asset is the result of a prepayment or overpayment of taxes. Deferred tax assets can also arise due to net loss to the company that can be carried over next several years. It's usually a good thing to find on a balance sheet, because the company could receive a future tax benefit. Next line item is non-current tax assets. It represents the tax refund from income tax authorities. Next line item is other non-current assets. It includes security deposit, prepaid expenses, other receivables and so on. Please remember these financial assets are always recorded at fair or market value. This is important concept in banking that will be covered later. It's time to understand current assets. Current assets are the assets that can be easily converted into cash within a year. You will notice there are several assets type classified as current asset. Let me list down. Inventories. Financial assets. Other current assets. We will understand each line item listed under current assets. Also, you can review corresponding note in annual report to understand what is included under each type of current assets. Let's start with inventories. Inventory includes raw and packing materials, work in progress and finished goods. It also includes stock in trade. Remember from income statement class. Stock in trade refers to the purchase of finished goods. For example, company purchases steel and tire for manufacturing of car. Next line is financial assets. It includes various financial assets that can be easily converted to cash within a year. It includes certificate of deposits with banks, purchase of government securities, mutual fund and so on. It also includes money due from customers. This is classified as trade receivables on balance sheet. Other current assets include all other assets that cannot be classified into previously discussed line items. It includes assets like advances given to suppliers and employees, balance with government authorities and so on. I hope you understand assets side of balance sheet now. In next session, I will review liabilities and equity side of balance sheet. Thank you.